Right now, as we look at the live tape, NVIDIA Corp is trading at exactly 172.52 USD, showing a significant intraday decline of 10.03 points, or roughly 5.49% in the red. We are seeing a massive red candle on the daily chart that is catching a lot of retail and institutional traders off guard, and if you are watching your brokerage app, you are likely seeing a lot of volatility alerts flashing across your screen. The market is currently open and active, and this price action is not a glitch. It is a direct response to breaking news that challenges the single most important narrative supporting this company's valuation. When you look at a stock that has effectively carried the entire S&P 500 on its back for the last few years, seeing a drop of this magnitude in a single session forces us to pause and ask if the fundamental thesis is cracking, or if this is just another buying opportunity in a long line of dips that were quickly bought up. The expectation from the street has been that demand for NVIDIA's H100 and Blackwell chips is infinite, a bottomless pit of capital expenditure from hyperscalers who have no choice but to pay whatever price Jensen Huang asks. That is the expectation, but the reality hitting the wire today is different. We are seeing reports that Meta Platforms, one of NVIDIA's largest and most critical customers, is in active discussions to shift a multi-billion-dollar portion of their infrastructure spending toward Google's proprietary tensor processing units, or TPUs. This is the news that is sucking the air out of the room. It's not just about lost revenue, it's about the breaking of the monopoly. The fear isn't just that NVIDIA will make less cash next quarter. The fear is that the biggest tech companies in the world are finally tired of paying the NVIDIA tax and are successfully building their own lifeboats. When you look at the intraday chart, the selling pressure began almost immediately at the opening bell. We saw a gap down from the previous close, and unlike typical sessions where dip buyers step in around 10 a.m., the selling volume has only accelerated. Institutional block orders are hitting the bid, pushing the price through key support levels that technical analysts were watching closely, specifically that 175 psychological floor. If you are managing your own capital through individual brokerage accounts, perhaps on Interactive Brokers or using the Robinhood app, you might be tempted to just close your eyes and hold, but you need to understand the mechanics of what is happening right now. This volume suggests that funds are de-risking. They aren't just trimming, they are rotating. The narrative that NVIDIA has no competition is being tested in real time. We are seeing similar weakness in other semiconductor names, but NVIDIA is taking the brunt of it because its valuation was priced for absolute perfection. When you are priced for perfection, any crack in the armor, any suggestion that your best customers are looking for alternatives gets punished severely. This is exactly what we are seeing today. It is a repricing of risk. The market is suddenly realizing that while NVIDIA has the best chips today, the timeline for when competitors, specifically internal competitors like Google and Meta, catch up might be shorter than the 5-year moat everyone was banking on. Let's talk about the retail investor sentiment because it plays a huge role here. If you look at the chatter on forums and social platforms, there is a mix of panic and denial. Many people holding NVIDIA stock in their Schwab Intelligent portfolios or Fidelity retirement accounts have never seen a sustained downtrend in this name. They are used to the stonks only go up paradigm. But markets have a way of humbling even the strongest trends. The danger here is the leverage. A lot of retail capital is long on margin, and a 5% move in the underlying asset can trigger margin calls that force liquidation, creating a cascading effect. We are likely seeing some of that forced selling right now. If you use Robinhood stock trading or SoFi active investing, you know how easy it is to get leveraged exposure. When the stock drops $10 in a few hours, those leveraged positions get wiped out, adding fuel to the fire. This is why the volatility is so high. It's not just fundamental selling, it's mechanical selling. The algos smell blood. They know that retail stops are sitting just below $170, and they are going to hunt for that liquidity. It is a brutal game, and today, NVIDIA shareholders are the ones on the receiving end. But let's strip away the price action for a moment and look at the actual business driver causing this dip. The report that Meta might use Google's chips is significant because it validates the in-house silicon thesis. For years, the bear case for NVIDIA was that eventually companies like Amazon, Google, and Microsoft would build their own chips. The bull case was that NVIDIA's CUDA software moat was so strong that the hardware didn't matter. You were locked into the ecosystem. If Meta, which has been accumulating NVIDIA GPUs like they are going out of style, is willing to risk using Google's TPUs, it implies that the software lock-in might not be as impenetrable as we thought. It suggests that for certain workloads, specifically inference, running the AI models rather than training them, the alternatives are good enough. And in this market, good enough at half the price is a serious threat to NVIDIA's gross margins. This is the tension between expectation and reality. The expectation is that NVIDIA is the only game in town. The reality is that the town is getting crowded. I want you to take a second and think about your own exposure. Comment below how many shares of NVIDIA you currently hold and what your average buy price is. Are you still in the green, or has this drop put you underwater? It's important to share these data points because it helps us understand the aggregate sentiment of the retail market. If everyone is still in profit, the panic might be contained. If people are trapped at higher prices, the selling could intensify as they try to exit at break-even. Now, we have to look at this in the context of the broader market. NVIDIA isn't trading in a vacuum. We're seeing Tesla stock and Apple stock react to their own idiosyncratic news, but NVIDIA is the bellwether for the entire AI trade. If NVIDIA sneezes, the whole tech sector catches a cold. We're seeing a drag on the NASDAQ today, and that affects everyone, whether you're picking individual stocks or just passively investing through Fidelity mutual funds or SoFi robo-advisor products. The correlation is high. When a trillion-dollar company drops 5%, it pulls down the indices. This matters for online investment platforms that offer investment help via automated rebalancing. If NVIDIA's weight in the index drops, these passive funds have to sell, creating more downward pressure. It's a feedback loop. This is why you need to pay attention even if you don't own NVIDIA directly. If you have an intelligent portfolio or use investing sites to manage a 401k, you are exposed to this volatility. But let's not lose sight of the long-term picture. While the market is freaking out about Meta and Google today, NVIDIA still has the Blackwell architecture rolling out. The demand for these next-gen chips is reportedly off the charts. Jensen Huang has stated that supply is the issue, not demand. So is the market overreacting? It is very possible. The market is a voting machine in the short term and a weighing machine in the long term. Today, the voters are scared. They are voting with their feet and exiting the stock. But the weight of NVIDIA's cash flow is still immense. They're generating profits that are practically unheard of in the hardware space. The company has a balance sheet that is a fortress. Even if they lose some market share to Google's TPUs, the total addressable market for AI compute is growing so fast that NVIDIA can still grow even with a smaller slice of the pie. The question is valuation. Is the company worth $4 trillion, or $3 trillion, or $5 trillion? That is what the market is trying to figure out today. The price discovery is messy, and it is painful if you're on the wrong side of it. If we look at the comparison with Tesla stock, there is a lesson there. Tesla was the undisputed king of EVs, priced for infinite growth. Then competition arrived, margins compressed, and the stock had to undergo a massive correction to find a realistic valuation. NVIDIA might be entering that phase. It doesn't mean the company is dying. It means the company is maturing. It is moving from a phase of growth at any cost to a phase of competitive reality. Investors who used Interactive Brokers stock trading to short the stock at the top are looking like geniuses today, but timing the top of a momentum stock is notoriously difficult. Most people trying to short NVIDIA have lost their shirts over the last 2 years. Today might be the day the bears finally get a meal, but one day does not make a trend. We need to see if this selling persists over the next few sessions or if the buy the dip crowd steps in at $165. Another angle to consider is the geopolitical risk, which is always lurking in the background for